and ETFs, we are witnessing today the downfall of that strategy, which is when things go down, the ETFs go down. And when people start panicking and selling and or redeeming,
or attempting to redeem,
that volatility comes back in a very, very unpleasant way.
Howdy, folks. Welcome to the Daily Coin. My name is Rory, and today is Sunday, March the 1st, 2020. I have the very distinct honor and great pleasure of welcoming a new guest to the show, and he is the CEO and director of a company that I've been following ever since its inception. It's one of Keith Neumeyer's children, and I love this company, love what they've been doing, and the way that the company has unfolded. I'm speaking of the CEO and director, Mr. Dan Wilton, and the experience that this gentleman brings to the table, which if you look at the screen right there, you'll see his full bio. It is impressive, to say the least. Dan, welcome to the Daily Coin.
Roy, thanks so much for having me, and you can't see it, but I'm kind of starting to blush for that that very kind introduction.
Well, it's I love this company. I mean that sincerely, and it's I want to tell people about, because they're going to be involved in this, and you guys are on 3 different exchanges, and you're on the Toronto Venture Exchange under the symbol FF. Here in the States on the over-the-counter market under the symbol FFMGF, and you're also on the Frankfurt market under the symbol FMG. And I understand, Dan, we were talking just before we started recording, that you just are getting back from a conference, and I stopped you mid-sentence because you were about to let the cat out of the bag, and I wanted to get it on record for the show about what you were hearing on the street at this mining, from the different mining executives that you were surrounded by at this conference. And what is the word on the street as far as where the mining sector is headed and what's going on with gold coming out of the ground?
Oh, well, it's a pretty interesting week when you think about the fact that, Monday you had gold spiking up, and then sort of where we were sitting by Friday, and the various perceptions of risk and everything else. But listen, this is one of the biggest gatherings of senior execs in the mining industry worldwide. And if I had to kind of characterize the environment, it was obviously optimistic, driven by the gold price. And I think everyone has a view that the fundamentals are there supporting the gold price going higher. A little bit of concern about how quickly the gold price had run over the course of the last couple of weeks, because I think it's due a far more sort of sustained march up. But that said, I think the biggest topic of conversation and the biggest change I've seen really since 2012 is that big mining companies are starting to talk about growth again, right? They are starting to talk about project development, and as echoed in the loudest by Barrick's CEO Mark Bristow said, we're at peak gold. This industry doesn't have the projects ready to replace, even replace reserves, let alone replace production. And the time lag to develop projects and the difficulty of finding them if you're just going through the exploration route, left certainly those of us with a portfolio of development projects feeling pretty optimistic about our place in the world here. Partly because, and a lot of people don't appreciate this, and it's not making it into the mainstream financial media at all. But with the gold price above $1,500 an ounce, the free cash flow to the gold sector is doubled what it was a year ago, more or less. And above 1,600, it's even higher than that. So, all of a sudden you've got these gold companies generating, more than twice the free cash flow on every ounce that they're selling. And they're reporting their year-end reserves, which have gone down because they haven't been able to replace reserves. So all this, and they are trading at 2 times their net asset value, and developers are trading at kind of 0.1 to 0.3 times their net asset value. So all of this is setting up what I think is a really, really interesting environment to be invested in developers, and obviously from our standpoint, to be invested in First Mining.
Guys are doing is really, like I said at the very beginning, you guys, I love what you all are doing. I think that it's incredible. And with the CEO over at Barrick, along with the CEO at Newmont as well, and Goldcorp, all saying the same thing about peak gold. I mean, and now we're, at the end of the week, we saw this massive pullback in gold. After the beginning of the week, we saw this really huge spike up, and then it all came crashing down by the end of the week. We saw back in 2011. What are your thoughts on that? I mean, do you think that that's where we're at? Do you think that we are going to see that in the next couple of years? What do you think about that?
I've been thinking a lot about this over the course of the last few weeks, and then, of course, the end of this week starts bringing, some important parallels to 2008. I think we need to understand what some of the differences are, and I don't think there's anything that we're presently looking at in the market that says that this is the potential full collapse of the financial system, which is, really what was driving some of the real seek for liquidity and risk off in 2008. When we think about what pushed the gold price to its all-time US dollar highs in 2011, we kind of forget this, but it was largely driven by the recognition that coming out of the financial crisis, imagine this, if you will, the U.S. government was going to borrow, just an unfathomable amount of money in that year to continue to support economic growth. They were going to borrow $1 trillion. And that was like an unprecedented borrowing, and people saw that as a major financial risk and a major risk to the currency. Well, here's the reality. They just announced budgets for the U.S. government this year that are $1 trillion, and no one's even blinking. No one's even paying attention to it. It barely makes headlines that the government is continuing, in this level of indebtedness. And at some point, with interest rates already where they are, real interest rates being negative, governments around the world just have very, very few policy alternatives to be able to stimulate economies. And so, if anything, what I think this move on Friday was about is the transition of the perception of risk into the fundamental economy as a result of COVID-19. So now people are really saying, like, this is going to cause a recession. And I think that might be the case. But if that's the case, I think what you see very quickly from here is a coordinated policy response among central banks, which is going to be injecting yet again an enormous amount of liquidity into the system. And they do that essentially by printing money. And all the more reason that when we see a pullback, and I kind of chuckle about a pullback in gold to 1585 and people being concerned about that impact on the equities. Like 1585 is a pretty healthy gold price in the ability for mining companies to generate free cash flow. And you're going into an environment where, central banks around the world are going to move to even more accommodative monetary policy to the extent they can. I mean, this is all setting up for, I think, a gold price environment that one can foresee. And listen, I'm not Keith. I'm not the guy who makes like the crazy calls on the gold price. But if you think about trough to peak gold price from 2002 to 2011, is there any reason why that can't look like the same trough to peak gold price from 2016, which call the trough 1050? I don't know. There's some pretty compelling arguments that could be the case.
I would agree completely. I mean, especially when you mentioned the central banks and firing up the printing press on a global scale because of what's going on with COVID-19, coronavirus. I mean, all of these things. Everybody globally is shaken by this. I mean, there's infinite articles around the world about supply chain disruptions and economic disruptions on a massive scale. And with that, I mean, it seems like that the economy is pretty fragile, and I would think that you would agree with that. And the euro and the pound, they're already not doing very well. Corporate indebtedness, negative interest rates, as you mentioned. I mean, how much worse do you think that these aspects can get that will actually be fuel for the fire for gold?
Yeah, well, like we're in uncharted territory,
Yeah,
really,
we really
because
are.
I don't think we've ever hit a recession in a period of negative real interest rates, right? Because
Yeah.
the fact that we have been stoking the fire for so long with interest rates that are so low, it just leads to some challenging, misallocations of capital over the longer term. And, I see there being no way that we can't have overbuilt some productive capacity when money is not just free, but from a fundamental perspective, people are paying you to take money. So, in the end, yeah, I think this can only be good for gold. It can only be kind of leading to that step change, and partly because all the developed or developing economies, for that matter, um, are all going to sort of be locked in their own race to the bottom from a currency perspective. Because, listen, China's going to want to continue to export. And so they're going to need to keep pace with a US dollar that's going to need to continue to devalue. And you think it through on the next step, with interest rates so low and corporate indebtedness, as you've said, so high, consumer indebtedness, at record levels. How do you get to a point where you can actually raise interest rates? Like your policy response? No, you would
You can't.
bankrupt. That's where
Exactly.
you really turn it into, you're bankrupting the economy. So the challenge with that is the policy routes out of it get tricky, and they get tricky in a sense that, I'm sure your listeners will be very familiar with the whole concept of modern monetary theory, um, because it's getting a lot of airplay in political circles in the U.S. But that basically just leads to a long-term devaluation of the wealth of your citizens, and there are very few protections against that when currencies globally are locked in a race to the bottom. You need a hard asset or commodity that's going to see you through, and that's the same role that gold has played over thousands of years. So it doesn't make you a very popular person at a cocktail party, but I think it is pretty valid to say that if you've been riding the equity markets up on the back of unprecedented liquidity injection, maybe you might want to be looking at a little bit of how you're protecting your downside in situations like this. And hopefully, we're not into markets that we think or there's going to be prolonged panic. But this is what we're seeing today is a panicky market that we haven't seen panicky markets like this, I think, since 2008.
At least I mean,
Yeah.
they were a mess in 2008, that's for sure. And we've seen a blip or two since then, but not really anything on the scale that we are. I mean, and even though I mean, Trump has been running around. President Trump has been running around celebrating the stock market and all the gains, and he connects them to his policies. And is it him or is it the Federal Reserve's debt binge? I mean, the so called not QE repo madness that's been going on for the past several months. That has been what's created this last little rise in the equities market. I mean, is that appears to be coming to an end? I mean, is it
Uh,
Trump or is it the Federal Reserve?
yeah, it's interesting. I mean, I think to the extent that anyone's going to take credit for it, I think President Trump will take credit for it, but he's taking credit for setting up an environment where the Federal Reserve has in the wake of economic concerns kept interest rates at very historic lows, and particularly real interest rates in a negative position. And it just ultimately that goes to distort asset allocation and capital allocation throughout the economy. So there's just no question that if you're in an environment where people are paying you to borrow money, which is essentially what's happening, um, you know, a rational person's going to kind of take as much as they can. Um, it's just such dangerous times when you're dealing in a position where now when you hit a bit of a fundamental speed bump in the global economy, what are your policy alternatives? Is the U.S. government going to go to a $2 trillion deficit because they need a bailout plan like they had in 2008? Um, like that's getting to be a lot of money with no real foreseeable path to how you get those deficits back under control.
Yeah, a trillion here, a trillion there. Pretty soon you're talking about real money.
Absolutely,
you know,
absolutely.
it's
Uh,
and what is I want to kind of shift gears and look at first mining gold. And what is Dan? What is this your strategy with in light of this backdrop that we've just painted? I mean, how are you guys going to take advantage of this?
yeah, well, I think particularly coming out of this week. Having spent a bit of time immersed in kind of the decision making centers of the industry, I think we're in a great position here. So first mining, for some of your listeners who may not be as familiar, we have a portfolio really of six gold projects in Canada. One of them, our Springpole project, is one of the largest undeveloped gold projects in Canada. All our projects are in great jurisdictions. Four of the six are in northwestern Ontario, not far kind of from the Red Lake Gold Camp, very prolific, long-standing gold mining area. And a couple of projects in Quebec and a project in Newfoundland. Our projects are well understood. Many of them were past producers, or they're very well kind of technically de-risked. And all of them have great exploration upside as well. So, we think that we're in a position here with our biggest project, Springpole. We have it in the permitting process right now. And we put out a preliminary economic assessment on it in October of last year, on the back of some really encouraging metallurgical work that we had done to, we think, kind of crack the code and increase the recoveries of the project, and had a very interesting increase in the economics that showed an after-tax net present value of $841 million US dollars at a $1,300 gold price and about $1.2 billion at a $1,500 gold price. So we still need to take the project through the permitting process. We're well advanced in that, and to the end of this year, we'll be working to kind of compile our environmental impact statement and get that submitted early next year. And that really starts what in Ontario has been a pretty stable clock and a time frame for the permitting process, which is 18 months to 2 years. And Ontario, where we're developing these projects, I think is one of the best permitting jurisdictions in the world. They've permitted 4 big open pit mines over the last 4 years. All similar or larger in scale than Springpole. So I think we have a great shot of moving the project forward, and ultimately, where we're trading from a value perspective, we have about 150 million market cap Canadian. So we'll call that 110 US today, and we think a fundamental value of our assets in this company that is, about 1.5 billion Canadian. So our job really over the course of the next year is moving the projects forward. I think demonstrating, hitting some real milestones, and demonstrating to our investors and to potential strategic partners in the industry that we're going to be able to permit and get this project at Springpole ready to go while we surface the value from the other projects in the portfolio, which each of them on their own in a rational gold market or a rational equity market where gold was at $1,500 and above should be worth $50 to $100 million on their own. So, we've got this. We're blessed with this great portfolio that Keith and the team put together, really at the bottom of the market in 2015, yes. 2016.
Yeah, they really did. And y'all are going to keep all of these projects too, right? Because originally, when First Mining was first developed, the idea was to corral, a bunch of distressed properties, make sure that what they say that they have, confirm that, and then sell it back into the market. And that strategy kind of changed, and now you guys are sitting on some really incredible properties. Is that right, or am I misremembering this?
No, that was exactly the thesis when they launched the mineral bank strategy under First Mining Finance. But there was kind of one flaw with that strategy as it was articulated, and that flaw is, if you're going to execute that strategy, it works really well if you buy large projects that really have no hope of being developed. So if you could buy them at $5 an ounce and then you'll trade at $10 an ounce for option value in the ground for the day when gold goes ballistic, then that's a bit of a different strategy. The challenge, as I say to people, is Keith and the team bought projects that were too good. So, by the time you own them and you wrap your head around what you have and, start identifying what some of the opportunities are in the portfolio, which is a process that I went through when I joined as CEO, having spent 5 years as a private equity fund manager with $800 million under management in 2 funds, looking around the world for late stage projects like these. Mm-hmm. You look in this portfolio at what are the investments you can make against these assets or in support of development of these assets to surface the most value. And it's all just about risk return. And so when I looked at this portfolio a year ago, having, just taken a month to try and understand what it was very clear to me that the single biggest value we can surface in this portfolio is getting a permit for Springpole. Because permitted projects should trade at, something in the realm of 0.5 times their net asset value. You look back over history in good markets and bad, that's kind of a benchmark. Then they tend to trade up from there in reasonable markets where, you may find partners who would come to buy them at, 1 times net asset value because big gold producers are trading at 2 times net asset value. So it's kind of an accretive, value cycle. And then a bigger company with a much lower cost of capital and, more experience and capability builds the mine. So I'm not saying that's 100% the strategy that we're just looking to sell the projects. That's not it. But the cost for us to get from here to having this project, de-risked from a permitting perspective, we think from here is, between now and the end of 2023, including, a bunch of our own holding costs, would be 20 million US. And so you think if you spend that 20 million US, you're ultimately going to be surfacing, if you're in a $1,500 gold environment, something that's going to look like, 600 million to a billion two based on our 2019 PEA. Like that's investment you should be making.
Yes.
So, that's really been the primary focus for us, and we built up the team last year, and importantly brought in Ken Enquist, who has a great background at moving projects through exactly this stage of evolution. And the last couple of projects that Ken was involved with and led the feasibilities for, one was Arizona Mining that ended up selling to South 32 for a couple of $1 billion last year. And prior to that, he was at Nevsun as they did the feasibility study on the Timok project in Serbia. And that ended up selling to a Chinese group for a couple of $1 billion. So Ken really understands what is the work that you need to do and how you need to do it to make the projects, understood by and appeal to the most discriminating and largest strategic buyers in the world. So that's kind of the lens that we're taking into developing these projects. It's not just trying to, put out a nice study that we can then, hope to raise next year's G&A and move forward. You really need to do a lot of the heavy lifting just to get these projects properly scoped. And so that's strategically what we're doing with each of these projects. But there's a priority to it. And if you're going to do it right, we're a small team with limited capital. We really need to focus. And that's why we recently announced this earn-in agreement on our Pickle Crow project with a great group of explorers out of Australia. So tell you more about that if that's of interest, because I think that kind of goes to show that from this original strategy, which was, we'll buy it cheap and then the market will go up and, we'll have a lot of interest and move it.
Right.
We are still, I think, in a point now of moving our assets towards the ability to surface value from them. We're not in an environment where we could just sell one of these things for $50 million today. So it's about finding partners and partners with access to capital that can do really important work to get these projects advanced and ready for when we get into that environment, that then, we and they are going to be able to surface even more value out of these projects.
Yeah.
So it's just, we're at such an important time because the developers have been so beaten up for so long.
But with this whole notion of peak gold being thrown around by, the largest gold companies in the world, I mean, the largest gold mining operations, I would think that all of the work that you guys are putting into Springpole and really showing the value there, I would think that would be of great interest to some of these other large companies. Maybe not these guys, but maybe some Chinese company that is looking to acquire gold mines, because China, I mean, from what I can tell, Dan, is that over the past couple of years, their internal gold mining has kind of peaked there, and it may even be dropping off. And so that's why they're acquiring gold mines around the world. I mean, that's what it looks like anyway. And for whatever reason that China is acquiring these gold mines, they are doing that. They're doing exactly that. They're not just buying the the bars out of London. They're buying the mine so that they have the whole thing from stem to stern. And that's what I mean. Is that kind of what you guys are looking at? I mean, I know that you want to make them productive mines, but I would think that there's a lot of people that are looking at what you guys are doing right now.
Yeah, there are, and it's made all the more interesting by the fact that um, the last time that a lot of big companies looked at spring pole, it was 2012. Right, it was kind of just after it was discovered, and they were drilling it out, and it was this really interesting geological anomaly. And the deposit sat under the bay of a lake, and so everyone looked at it and said, "Interesting geology, big, kind of low grade, and it's going to be hard, and we don't know, if there's any species at risk in that lake, and I think it'll take you forever to permit it. So thanks, but we'll look at it later." And so when you go back to a bunch of these companies that haven't looked at it since 2012, and first of all, none of them have had budgets to look at anything since 2012, by and
Right.
large.
And now they do.
And that has changed. But we forget that that's only changed in the last 6 months, right?
Right.
It's only since the gold price has ticked up above 1,500 that free cash flow to the gold industry has doubled, or more than doubled, with where we are, over the course of this past week. So it's a really interesting time that then you can go back to them and say, well, yeah, understand what all your concerns were. And by the way, here's all the work that's been done over the last 8 years. Here's a 380-page environmental baseline report compiled over 7 years, the conclusion of which is there's no species at risk in this bay of Springpole Lake, and there's no unique habitat that can't be compensated for elsewhere in the watershed. So when you show them data, you show them geotechnical drilling under the footings of the cofferdams, and then you show them the team that's taking it through pre-feasibility study. Like you were at the point of actually, having people focus again, because there really, back to the original point, there really aren't that many projects in jurisdictions that you would want to own a project that are permittable, and particularly there really aren't many that can produce over 400,000 ounces a year. And
that's the thing. That's the big thing, is that there aren't any really large scale mines coming online. That's the whole problem.
No one has developed these projects. So in Canada, there have been, I'd say 4 projects permitted over the course of the last 4 years. Cote Lake that IAMGOLD and Sumitomo have, and the Hard Rock project that's Centerra and Premier, which is locked in a lawsuit over ownership and operatorship, and the Magino project that Argonaut has, and the Hammond Reef project that Agnico has, that I didn't actually appreciate that it had its permits until I was looking at it yesterday. And none of these projects are being built right now. So it's kind of led to this view of, oh, well, it just means that no one's going to want to develop Springpole. But all of these projects, keeping in mind that we're only 6 months into this period of greater free cash flow, they're all in the process of all of a sudden now getting ready to raise their financing and get these projects moving forward. So, and beyond that, like really, the cupboard is bare. It really is.
Yep.
So this is I think a pretty unique opportunity over the next 2 or 3 years. And listen, people will want to see risk taken out of the projects. And that's exactly what we are doing. Spending, people ask us, in the articulation of the strategy, it is spending, reasonable, but the limited amount of capital that we can to take the maximum amount of risk out of these projects. And that could be making them bigger. It could be, getting permits. It could be understanding each of the key risks in each of the projects, so that you just answer that one more question that a potential partner might have. But that really has been the game plan here over the last year, and we're just in the process of closing a financing here that's going to have the capital to continue to move the projects forward here. So, and
Okay.
great support from our existing investors, which has been lovely.
Well, you guys are in just an unbelievable position with the development of all these projects up there. I mean, would you say that everything that you've just been describing, would you say that that makes your tier one assets a little bit unique, or is there something else about what you guys have that would differentiate you even more so?
Oh, listen, I think the portfolio of projects that we have and the quality of the assets at the stage that they are at, I think makes us unique. I think the fact that all of these projects are in absolute tier one jurisdictions where that is a real differentiating factor for how
Yes.
you move projects forward. And do you want to own them? I think that the jurisdiction is so critical for us. And then I think you drill down into each of the projects, and the fact that they're well understood, well studied, or past producing mines with a lot of data, with great infrastructure around them. Even Springpole, for all that people perceive it as a remote project, we're 35 kilometers from a power line and 35 kilometers from a class 1 forest road.
Wow.
So to contrast that with some of the other projects that we were chatting with another big company yesterday that's in the process of a big expansion of a mine at 5,000 meters in the Andes, and they're literally right now building a desalination plant and a pipeline to provide water to the project.
Wow.
That sort of amount of infrastructure that you need versus the cost of the mine for all of our projects is really manageable. So listen, I think we have a challenge in demonstrating that there's value beyond just Springpole. It tends to kind of overshadow everything else. It still has permitting risk, and while the project economics are compelling, it's a big capital cost number. So that causes some potential investors to sort of pause. But I think from our perspective, where we're going in this industry, we have an unbelievable portfolio of projects that we're just in the very early days of being able to attract, both capital from investors in the market and attract capital from other potentially interested strategic partners over time here. So,
Yeah, I
we
would
think
think that you're attracting all kinds of investors at this point. I mean, if not, then I don't know what investors would be looking at, and be perfectly honest. I mean, my goodness, you know.
well, that's the institutional investors in the mining sector, kind of dedicated mining funds. They have been remarkably on the sidelines on development companies for 3 or 4 years. And it was that perception of there's not enough capital in the industry, and strategic partners or strategic acquirers weren't buying projects or adding projects. So why do I want to be the one who's stuck holding it while you just kind of slowly move it forward? There was some validity to that thesis in 2014, 2015, 2016 for sure. But I think that leaves us in a position where those of us who have been able to advance our projects, and I'm a big hockey fan, and there's a great saying by the great Wayne Gretzky that you skate to where the puck's going to be, you don't skate to where the puck is. You need to look at where this industry is going to be 2 or 3 years from now, and all you need to know is this industry setup, which is right now the run rate of free cash flow is more than double what it was last year.
Right.
And big companies are having trouble replacing their reserves.
Right.
I mean, just with that is the industry backdrop. Two kind of indisputable facts leads you. Oh, and the third part being producers are trading at 1.5 to 2 times the net asset value of their projects, and developers are trading at 0.1 to 0.3 times.
and you're let's not forget the fourth point, which is peak gold.
Gold.
So,
Absolutely. And that
I mean, if
the
you've
gold
got,
price environment, that there is no situation in which, it looks like there's a call for gold to go much lower on the demand side, or on the supply side is supportive of increasing price as well. So
I just don't. I mean, when you've got the CEOs of the largest gold mining operations in the history of the world coming out saying that they're using those two words, peak gold, people should pay attention to that. I mean, that's really. I mean, I'm not the sharpest tool in the shed, but I'm not that dull. I mean, in
well, and a
all
lot of
honesty.
that you got to keep in mind, they are still having to condition some of their own investors' expectations over after years of having your big, portfolio managers saying the mining industry has misallocated capital, and look at all those deals you did in 2010 and 2011. Well, here's the reality. If you look at a lot of those big projects that, yeah, they might have paid a little bit more for, but if they actually moved them forward and got them producing in a $1,500 gold environment, everyone's going to look like a hero and a genius. So,
There you go.
and part of it's the that kind of short term outlook of most of the portfolio investors and institutional investors in the mining sector. It's why we are absolutely blessed with a shareholder base, and it's not with some great institutional investors who are here for us in the long term, and we're very blessed to have them. But we're equally blessed to have a very large, retail and high net worth investor base who have been here supporting us, and they support us every day, buying shares in the market. And, when we need to raise a bit of capital, they've always been there for us. And, lots of great people who followed Keith for a long time. And, Keith's made a lot of money for them on First
Yep.
Majestic and other things. So, yeah, no, we're just in the process of closing this financing, and I am, honored and blessed by the trust and conviction that our shareholders have. So
Yeah,
it's great.
and the thing is, Dan, and this is the last comment that I'm going to have is, if these guys look like geniuses at $1,500 gold, they're probably going to look like Superman when it's $1,800 gold.
Yeah, yeah.
That's.
Listen, people, you got to remember, like 9 months ago, people were talking about $1,700 gold as a fantasy, right?
Yeah, and we
And
and
we
we
were
were staring it down
10,
Monday.
$10 away on Monday. So, I just think this is all, you look at the rest of the macro picture here, and with central banks with such limited, tools at their disposal.
Exactly.
I just think anyone who's really benefited from this last push up in the equity markets, at some point, you got to start looking at what you might rotate into for a bit of safety if we're in this prolonged period. And I think, the gold price is telling us it's going to outperform, and then the strategic market will come in behind that. So, yeah, it's exciting times.
It is very exciting times. And is there anything that you would like to leave the audience with, or have we covered it pretty well?
Oh, I think we've covered it all pretty well. We've got lots of catalysts coming up for us this year. As we move our projects forward, both in trying to surface some value from some of the other assets in the portfolio, from some of the great work that we're doing at Springpole, and from a bunch of, lest we forget, some of the drill results at our Gold Lund project, which is, one of the highest grade open pit projects in Canada. And we're having some great drill success last year, and continuing to drill and expand that. So yeah, lots going on. And if people are continuing to watch it or have any questions, they can always feel free to get in touch with us. And we're always happy to spend more time trying to educate our shareholders and make sure they understand kind of where we're going with the company. So it's fantastic.
Sounds great. And we've been speaking with Dan Wilton, and he is the CEO and director of First Mining Gold. And you can contact him over at firstmininggold.com, and you can find their stock listed on the Toronto Venture Exchange under the symbol FF, here in the States on the OTC market under the symbol FFMGF, and on the Frankfurt market under the symbol FMG. And Dan, I really appreciate all your time. This has been an incredible conversation, and I look forward to speaking with you in the follow up in the not too distant future.
Well, that's great. I really appreciate you having me on the show today, and we'll look forward to catching up again soon.
Sounds great. Thank you so much.
Okay, thanks, Mark.